Live from New York City this morning. Good morning, good morning. Can we bounce back? The longest losing streak since early October. Equity futures just about positive. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open with Jonathan Ferro.
Live from New York City, we begin with a big issue. How many times have you heard this?
Bonds are back.
BARB, which is bonds are back.
You buy bonds because you think recession.
It's a good idea to own bonds right now.
You buy bonds because you want to be hedged.
It's definitely the year of the bond.
Steve Major of HSBC agrees. High yields mean that fixed income investors can reasonably expect to recover more of their 2022 losses. Their 10-year forecast on a 10-year Treasury for next year, 250. For the end of the year. Eric Nelson of Wells Fargo taking the other side of that. One of our highest conviction views heading into 23 is that a 10-year US Treasury yield of 350 is simply too low. The 10-year nominal yield should trade up to 425 to 475 through early 2023. So which one is it? Here's PGIM's Robert Tipp.
Big picture strategically, I think we're in a buy zone. But tactically, are we a bit overbought here? I'd say yes. At the back end, these long forward rates are assuming that, 2+ years from now, a 2.5% Fed funds rate is in the bag. It is going back down for sure. Hey, that's a possibility, but I think that's highly overrated.
Joining us now to discuss is JP Morgan's Kelsey Barrow, Colin Martin at Charles Schwab. Kelsey, first to you. A 10-year Treasury yield's too low.
I would agree with the sentiment that I heard in the intro, which is that tactically, we may have run a little bit too far as it relates to this rally in yields. But I don't want to lose sight of the big picture. We do believe that bonds are back, and for the first time in a decade, you're getting income and diversification from your fixed income portfolio. If you remember back, not that long ago, 30% of the global ag had negative yields. Now only less than 3% has. And yields on the benchmarks are 2 to 3 times higher. And on the diversification side, that's been the challenge for all of 2022. You've had risk assets decline, and you've had bonds decline with them. We think now that the Fed is closer to pausing, inflation is starting to roll over, you're going to get those diversification properties from fixed income as well.
Colin, you heard it from Kelsey. You heard it from multiple others. Bonds are back, bonds are back, bonds are back. Are bonds back, Colin?
Bonds are back. We just published our 2023 outlook, and that's our main theme. So it seems like we're basically in line with most of the street. When we hear about all those views, we're generally in the camp that we do think yields should fall in 2023, but not without some volatility. When we came out with what our trading range should be, or what our sort of target is for the end of next year, we put it in the 3% to 3.25% range for the 10-year Treasury yield. That seemed like a much more bold call just a few weeks ago, and now at below 3.5%, we're not that far off. So our bonds, too low, our bond yield's too low right now. Maybe, we might see them rise a little bit in the near term, depending on what the economic outlook looks like and the incoming data. But the way we're positioning it and what we're telling our clients is that bonds are back. We do expect yields to decline, albeit with some volatility over the next 12 months. And we continue to suggest investors lock in some of those higher yields with certainty now.
Colin, here's the pushback, and it comes from Citi. And Andrew Hollenhorst a little bit earlier this morning when he published, he said the following: "We've been perplexed by the fall in Treasury yields, which continued yesterday. Markets are pricing a terminal Fed funds policy rate about 100 basis points above current levels, but then a rising probability of cuts in 23. That's possible. It's a possible hopeful scenario, but not a likely one in our view." What would you say back to that, Colin?
Well, I think the big question is about that potential cut. Markets are pricing in the rate cut by the end of next year, but a lot of Fed officials, including Jay Powell, have strongly pushed against that. They want to hike up to 5% or so and hold to really see how it plays out. When we look at how low yields are today, given expectations for another 100 basis points of tightening, we continue to see a deeper and more inverted yield curve. What that's telling us, though, is that the markets are expecting a negative scenario, negative results as a result of all this tightening. They expect growth to slow. They expect inflation to come down. We're starting to see it in the housing market, of course. A lot of, or certain parts of the market are showing more resilience, like the consumer. But we're in the camp that we do expect growth to slow. We do expect inflation to continue to come down as it has. And when all's said and done, over the next 12 to 18 months, we are beginning to price in those rate cuts.
Kelsey, I know you're focused on this. Which one should I be focused on? The next 100 basis points of hikes or the cuts on the horizon being priced?
So it's been very interesting to look at the price action because the terminal rate pricing has been very sticky. Everybody is in the same camp. They think that the Fed is going to 5. They're going to get there in the first half of the year. And then what the market has been doing recently, all the volatility in yields has been driven by the market pricing of rate cuts. So through June of 2023 to June of 2024, the market is pricing in about 140 basis points of rate cuts. And I do think there is room for the Fed in the near term to push back on this narrative just a little bit because we're really not out of the woods yet as it relates to inflation. Now, we do think inflation is coming down, but we do have to remember that we've only gotten one CPI report and one PCE report that were encouraging. And there have been false starts before. There have been false dawns before. And so that's why I think in the very near term, we've seen a strong rally in bonds. The 10-year yield is highly inverted to the cash rate now. And we may see the Fed try to push back on that a little bit when it comes to the dot plot next week.
Kelsey, they are pushing back. We've heard it a million times, haven't we, over the last month? What do you make of the fact that this market isn't really responding to it?
Well, I think that the market is very focused on the fact that they believe that inflation is going to continue to come down. And the leading indicators are there. They are there more than they were the last time that we got a weak CPI report and it ended up being a false down over the summer. If you look at, for instance, supply chains, if you look at, for instance, import prices, and you look at rental prices, I mean, these things are coming down. And so I think the market right now is really hopeful for a soft landing. And this is where we'd say maybe a little bit too much optimism. The rates market is pricing a very high level of concern about the forward trajectory for growth in the second half of 2023. Where we're seeing a lot of complacency is on the credit side. Spreads in high yield and investment grades still look very much like they're pricing in a soft landing, like they're pricing in a scenario where everything just turns out fine, despite the fact that we have seen the most aggressive rate tightening cycle since the 1980s.
So, Kelsey, the pushback, and you know it well, you've probably heard it on this program a few times as well. The pushback is the quality of the high yield index has improved markedly over the last 5 years. And the pushback is that even if we go into a downturn, you can't expect high yield spreads to gap wider in the way they have done in previous downturns. Kelsey, what are you saying back to the people that present that argument to you?
The quality is better. There is no doubting that. That's in the numbers. When you look at the ratings mix, it's improved over time. Some of that weaker quality has gone into the loan market, but ultimately we look back at every recession and spreads do widen into the recession. So maybe you don't get the blowout to 1,000 basis points, it's only 600 or 800 basis points. But for us, we want to be invested in fixed income. This is a time to take advantage of income and diversification. We're having those conversations with our clients, but we're also saying stay high quality. We've seen an enormous amount of tightening and spreads are still very complacent here.
So, Kelsey, right now they're about 450. What would you say is the appropriate level for credit spreads? I'm trying to work out what you and the team are waiting for. How much wider they need to be for you to say it's time to step in?
So it is extremely difficult to time exactly the peak in spreads. They're at the peak in spreads for only a moment in time, and then you start to see the policy reaction and they come back in. So we would try to be scaling into high yield as spreads widen and become more consistent with a recession probability. So in my mind, that's 600, 650, 700. You're stepping into those markets as they are widening, knowing hoping that the all-in yield and the break-even, the fundamentals, are going to support you as you enter that market.
Colin, do you agree? And I guess when you say bonds are back, you don't exactly mean high-yield credit yet.
That's right, not yet, John. And I agree with almost all of Kelsey's points. If we look at what the upside for yields is, if you look historically, I think it's easy to point to that 800 basis point level as I don't want to say a goal because that implies a good thing, but somewhere where high yield spreads could rise as we enter a recession. But maybe because of that higher quality mix, maybe we don't get to that level. So we're looking more in that 6.5%, 7% or above. But as Kelsey said, you'll gradually move in to take advantage of higher spreads. I think an interesting point about that pushback that you highlighted about that higher rated quality mix. Again, Kelsey made a really good point about the loan market. If you look at high yield and loans, you have to look at it in aggregate, and loans tend to be more in that single B range. But also, if we look at number of issuers, this is something we've been looking at. The number of issuers that have low B or below ratings has really risen over the past decade. And our take on that is that's been a result of the low interest rate environment, people looking for yields. And there's been these corporations that might not have a lot of debt outstanding, but were able to tap the markets, were able to issue debt with those low ratings because there was demand for them. So even though these are small companies with maybe not a lot of debt outstanding by themselves, if you add them together, we think that poses a risk as we enter a slowdown.
Kelsey, just one final question on the Fed looking ahead to next week. I'd love your view on this. There are three tools for the Fed next week, for the chairman at least. He can communicate through the statement, through the projections, through the news conference. What do you think he's going to lean on to push back against financial conditions? One of those three? All of those three? What are you more focused on?
The dot plot is going to be very interesting. I think you are going to see more participants pencil in a policy rate above 5 for 2023. So the distribution of the dot plot in September was really interesting because 5 appeared to be a ceiling. Nobody projected, not even the most hawkish member of the Fed, projected that the policy rate could go above 5. I think you are going to see a few policy members suggest that getting a bit above 5 is going to be appropriate. But I think also he's going to need to communicate a few more things in the press conference, particularly around wages. He's talked about the fact that the rental or service inflation ex rental prices is really going to be the most challenging part of inflation for the Fed to tackle. And the risk is that they claim victory too early, wages end up staying sticky, they pause at 5%, and then they have to go even higher when they realize that the labor market hasn't weakened enough to get the outcome that they're looking for.
We'll talk about that next. Kelsey Barrow, Colin Martin, sticking with us. Right now, equity futures recovering somewhat, up 0.5% on the S&P. Coming up, is the consumer tapping out?
What you see in our deposit balances is year over year, they're up about 10% for, say, median income households, but they're starting to deplete.
That conversation up next.
We're slowing down, there's no question about it, but we're not in a recession yet. Consumers and businesses are still spending, and why wouldn't they be? Excess savings, is around 1.5 trillion among consumers. That's down pretty significantly from the pandemic high of 2.3 trillion, but it's still pretty high. And moreover, the labor market's really strong. This cash cushion means we can ride out the first half of next year without a recession, but then I think we're going to see the economy dip.
Mounting concerns over the fate of the U.S. consumer. U.S. Bancorp's chief seeing an inflection point in consumer spending, saying the following: things are good today, but that cash cushion is going to start to dissipate, and that will create a change in behavior. Synchrony's CFO highlighted the difficult spending decisions facing Americans already, saying the following: what we hear today is, I can't make my rent. It's up. Inflation is killing me on gas, on groceries. You see that. Team coverage starts right now with Shanali Basak and Mike McKee. Hey, Shanali.
John, that's a really realistic view here because you hear a lot of the bank CEOs still saying the consumer is healthy, the consumer is healthy. And while that might be true, you have to take a note here from a person like Richard Fairbank, who has run Capital One for decades here. His stock this year is down about 35%. And he's saying while credit metrics are still holding up all right, better than they were in the past, the trajectory is what is the bad news. Now, you take Jane Fraser, for example, over at Citigroup, and what she is thinking of here is a rolling recession around the world, in which case the American consumer is still in much better shape than what you're seeing around the rest of the world. And there's some benefit here, she says, to that rolling recession because the whole world doesn't go into trouble at the same time in a better case scenario here. But there still is, in her view here, a likely recession next year. You've heard Brian Moynihan say that could be mild, but you hear a lot more skepticism from a lot of others like David Solomon over there at Goldman Sachs and some of his biggest hedge fund clients as well that have still taking a bearish view. Just a couple months ago, John, we were talking about how the consumer would hold up these banks, and now you see it in the stocks that they're performing much more poorly when they're exposed to consumers. What
a turn. Mike McKee, we've been talking about this for a while. You heard it in Shonali's conversations throughout this week. Just how big is that cushion, and what's left of it, Mike?
Well, there are varying kinds of estimates, John, about how much is left of the cushion. You can see that we put an enormous amount of money, $4.5 trillion or so into the economy, the federal government did, when the pandemic began. Now it's been spent down to maybe $1.7 trillion, which is still a lot of money. But the big thing here is this is what Shonali was talking about, the idea of momentum starting to shift. You can see in the yellow line there, consumer spending, that is bank deposits rather, starting to roll over as people start to spend down what they had in the bank. However, credit card use picking up, and you can see there that we are still at debt-to-income ratios below where we were pre-pandemic and below where we were quite some time ago in the early parts of this century. So we can still afford to take out more credit card debt, and that's kind of the debate here is, do we see people stop spending because the cash cushion goes down, or do they just change the way they finance it? Now, what we are seeing is a decline in retail sales since the Fed started raising interest rates. That's the Red Book year over year weekly spending patterns. And so the question is it that that's going down, or that it is still higher than it was pre-pandemic? And that's going to be the question when we come down on a percentage basis in terms of spending. Does it drop below where we were and then suggest we're going to have a contraction, or does it just mean that we get some negative numbers in spending, but we don't see people stop spending?
So, Mike, this raises a question I asked a little bit earlier this morning. The base case is we get a recession next year. I'm trying to work out if the bigger risk is that gets brought forward or pushed out. Mike, as you read things right now, the balance of risks around that story, what is it?
Well, the balance of risk would probably tell you that it gets pushed out a little bit, maybe, because Americans are still spending and we're still seeing people get raises. So if inflation's coming down and Americans are making more relatively able to keep more of their paychecks, then that means they can keep spending for longer. And we know from historical studies that Americans' spending is primarily based on what they earn rather than what they have in the bank or any kind of additional bonus.
Mike McKee, great as always. Shonali, thank you to you. We're going to catch up with you again in about 20 minutes' time. Looking forward to that conversation on Blackstone and real estate. You don't want to miss that. Back with us, Kelsey Barrow, Colin Martin. Kelsey, to you, how do you think about this issue right now? Just how big that cushion is for consumers, if there's a cliff edge at some point on the horizon?
Well, it's not a cliff edge. We have been seeing consumers draw down on their savings. So the way I would think about the health of the consumer is ability and willingness. So right now, I would say on the willingness side, there is still a lot of willingness to spend. People want to go out, they want to have experiences, and they still have a job with an income to support that. On the other side, you have ability. We know that the cushion of savings is coming down, but at the same time, they can lever up. They can take on more credit card debt. We're seeing that. We're seeing people start to use their credit cards more instead of drawing down on those savings. And so there is both ability and willingness right now for the consumer to continue to spend. And I think that has really been the bright spot and the engine in this economy, despite the fact that we are clearly in a recession when it comes to the housing and manufacturing parts of the economy.
So, Colin, this raises a few questions for me. I'm told repeatedly about how strong consumer balance sheets are. And to Kelsey's point, there is space there to continue levering up. With that in mind, Colin, does that tell you more about how deep a potential recession could be? Or does it tell you that actually we should be thinking this recession might be pushed further out?
Well, I think there is a chance that it gets pushed further out because as we stand now, we're already at the end of 2022 right now. The labor market remains strong. Non-farm payroll gains remain strong. We're still seeing wage growth and we're still seeing strong spending numbers. So it does look like there's a chance that it gets pushed back. I think a risk that when we talk about consumer credit and borrowing going up, that doesn't sound like a good thing to me, especially in a rising rate environment. I think it makes it way more difficult for consumers if they've depleted their savings and then they start borrowing at higher rates, whether it's credit card rates, higher auto loan rates, or home equity loans. I think that's a problem down the road. Now, I think when you look at the big picture, we're seeing all the signs of concern out there, especially with bank CEOs, various survey measures, but we're just not seeing it in the spending data just yet. We do expect that to happen probably in 2023. I think when you look over the last 6 to 12 months, we saw, really the first summer vacation season where people were spending, then that goes into the holiday spending season. As the calendar turns, we go into 2023, we do expect some of that spending growth to slow.
Colin, if you were looking for World Cup football today and you accidentally stumbled into a business channel and heard this conversation, there's no World Cup today for what it's worth, and you heard in the space of 10 minutes concerns about wage pressure and then at the same time talk of recession, Colin, how would you explain that to people?
Yeah, I think it is a challenge. I mean, we hear about recession a lot, but you don't really see it in the numbers just yet. You see it in some surveys, but not the actual hard data. Our concern, and it's all related with wage growth and then the Fed reaction function. When we see wage growth lead to inflation and then tighter Fed policy and tighter financial conditions, that should slow growth. I mean, it's making the cost of money more expensive. It's going to make it more prohibitive for me, for you, for any consumer to continue spending at the rate that we're spending at. So while things might look pretty good right now at the actual data, when we look at the outlook for tighter financial conditions, banks tightening lending standards, and just making the cost of spending go up, that's a risk to us.
Hey, Colin, great as always with a brilliant Kelsey Barrow. To the two of you, thank you. Coming up, why Bank of America thinks not owning equities into the new year is a big risk. That conversation's still ahead with Morgan Stanley's Dan Skelly. Four minutes away from the opening bell. Let's get you some morning calls. First up, Argus upgrading AT&T to buy, saying telecoms historically perform well during slowdowns. Piper Sandler initiating coverage on JP Morgan. Overweight, calling it their favourite quality name. And finally, UBS upgrading Hersey to buy, seeing a promising setup for growth next year. That stock is up by 1.6%. Coming up, why Bank of America believes not owning equities is a big risk and why Morgan Stanley's Dan Skelly is taking the other side of that bet. That conversation up next. Equity futures positive. The opening bell just around the corner. Five-day losing streak on the S&P 500. Longest losing streak going all the way back to early October. Right now, trying to make sure it doesn't become 6. Equities up by 0.5% on the S&P. On the Nasdaq, we're firmer by 0.5%. Also on the Russell, the small caps up by close to 0.6%. Let's see if this sticks. There's your opening bell. Switch at the board and get to the bond market. Going into next week, when we get CPI and a Federal Reserve decision, yields are higher by 6 or 7 basis points to 348.19 on a 10-year. Interested in the front end of the curve in the Treasury market, a 2-year at about 430. BMO think there's some real upside risk here. A 2-year that's facing 450 on Fed funds next week and a higher dot plot as well. Going into it, they think that yield needs to be higher. In the FX market, euro dollar 105.30, positive 0.2%. Some dollar weakness again. Bit of euro strength and crude. What a year it's been for this market. $74 a barrel on WTI, up by 2.8%, and still risking finishing the year in negative territory. Hardly anyone would have seen that coming about 6 months ago. Equities right now up 0.5% on the S&P 500. On the Nasdaq, up 0.5% also. About 40 seconds into the session, one stock to watch, Carvana. The company's creditors preparing for negotiations to rework the debt load. Wedbush slashing their price target on the stock to $1. Writing the following: these developments could leave the equity worthless in a bankruptcy scenario or highly diluted in a best case. Here's Abby for more. Hey, Abby.
Hey, John. Well, yeah, it's really pretty incredible here. And that, of course, is because equity stock is the lowest in the capital structure, so last to get paid. But, one question we often ask about securities, how low can it go? Well, in the case of Carvana, not much lower. It is down 99% literally from its August 2021 peak. And a lot of this has to do with profitability. Now, this once darling online used car company, in 2021, they put up a loss of $1.62. This year, John, that estimated loss is of $8.91. Next year, it's expected to be a loss of greater than $9. But this really isn't a stock story. To your point, it is a credit story. One bond is now trading at 41 cents on the dollar. Once you have bonds go below 50 cents on the dollar, it's often wondered whether or not there's a going concern risk. And of course, that's what's happening here. There is the possibility of restructuring the obligations. And one thing Carvana could have done, they could have tried to pit one creditor against the other, but the creditors, including Apollo and PIMCO, they're coming together to try to restructure them down, to restructure the bonds together, probably so that they get paid the most that they possibly can. I was talking about profits. There it is. It's really an issue, not just from the standpoint of profitability on the balance sheet, but also for the cars, the profitability per car. So it's interesting, John, because at the peak, this had been a $376 stock. Revenue is actually for this year up 33%. But that profit picture of profits just going absolutely in the wrong direction tells you that there's either a problem with the business model or maybe it's coming out of the pandemic. It's an interesting thing to ponder. And playing it forward, what other companies? We had headlines not so long ago about Blue Apron, some of them talking about that they believe that they have sufficient cash flow. The stock had been held pending. They're going to be working things out with their creditors. Sure, they're talking about how many more companies will we be seeing this through this more difficult environment.
What a brutal turnaround. What a brutal sell-off. Abby, thank you. One further stock to look at, one more name. Tesla, down every single day this week. This morning, down by about 6 or 0.7%. China's reopening prospects giving no reprieve to the name. The car maker said to be shortening production shifts at its Shanghai factory and delaying the onboarding of new hires. Dan Ives of Wedbush seeing it as nothing more than a near-term setback.
I think you're starting to see a bit of a demand issue in China. And that's something that I think Tesla's adjusting to. I still view it more near-term, not a long-term systemic issue. But look, after a Cinderella story, that they're starting to clearly hit some hurdles in China. But our thesis for 23 in terms of 2 million units globally continues to stand.
Ed Ludlow on the West Coast with more. Morning, Ed.
Yeah, good morning, Jonathan. We're down about 1.2% on Tesla, as you said, down for a fourth straight day. Its worst run of declines in almost 3 weeks. What Tesla is doing, according to sources, is cutting the number of hours across 2 shifts at the Shanghai plant, and they will stop onboarding new hires, which gives us a sense of the direction of travel for the ramp in production there. It's worth noting 2 things, Jonathan. They are coming off a record month in November in terms of vehicles produced and delivered out of that Shanghai plant domestically and internationally. As always, we went to representatives of Tesla in China and requested comment. A representative for Tesla in China declined to comment in the story. That's just one of 3. There's a lot in the news cycle around Tesla that investors are passing this morning. The second being that, according to sources, Musk's bankers are considering swapping out about $3 billion of the unsecured debt at 11.75% for margin loans, secured or backed against Tesla stock. This has been an ongoing story, as you know, John. As always, according to sources, this is not a final decision and the situation could change. But as we know, the debt which was taken out by Musk and put on Twitter could have annual payments of $1.2 billion. So this would somewhat lighten the load for the company itself, but put more risk onto Musk. The third story, Jonathan, if I may, we reported overnight, my colleagues and I, that Tesla has moved its head of China, Tom Zhou, from Shanghai to Austin, and he has come with a team of engineers, according to sources, to help with the ramp there and get things sorted in what is a really critical US operation for this company.
Nice reporting, Ed. As always, buddy. Thank you, mate. Stock's down about 1.5% on Tesla. For the broader market, about 5 minutes into this session, we're positive 0.2% on the S&P. On the Nasdaq, we're up about 0.1% or so. We caught up with Bank of America's Savita Subramanian recently, saying the biggest risk for investors heading into 2023 is not owning equities.
I do think that we are going to go down and then up. The problem is that is an increasingly consensus view. So I think the bigger risk heading into the first half is actually not being invested in equities. Not having exposure to stocks and sticking all your money in bonds and cash is a mistake at this point.
Invesco's Alessio De Longis agrees. He wrote the following: our macro framework moves to a recovery regime. As improving risk appetite signals improving growth expectations in the near term, this presents an opportunity to tactically increase portfolio risk. Dan Skelly of Morgan Stanley joins us right now. And Dan, I guess your first job is to tell me why they're wrong.
Sure. Good morning, Jonathan. And look, we've heard a lot of sell-side updates in the last couple of weeks, but let's face it, the markets continue to dance to the tactical drumbeat of Mike Wilson. And, you know, he was calling for a tactical rally in October. And just over the last week or so, you know, as a firm, we've become a little bit more cautious, just given we've rallied so hard off of those October lows. So, Jonathan, look, I would say the following. It has been a grueling bear cycle the last 10 months for almost everything, stocks, bonds, et cetera. I think, as you well know, and we've talked about for a long time, the original thesis was about fire and ice, Fed pivot, tightening, and then a growth slowdown. Obviously, phase one has played out. I think phase two, you could argue, is also seeing signals that it's being reflected. Just look at, frankly, the move in the long bond over the last, call it 30 or 40 days or so. We've had like a 15% move long in terms of duration. Look at the slowdown in WTI and oil prices. So you can't deny that a growth slowdown is starting to be reflected in certain asset classes. Just lastly, why are we not going all in aggressive at the moment and becoming incrementally cautious? It's all about earnings. As Lisa Shallot has said, as Mike Wilson has said, we still expect some earnings disappointments come January, February.
Dan, much of this year, though, at times, when you were making these big calls, you were flying solo. Now you've got a lot of company. When I played that sound there from Savita, it's the first time I'd heard that kind of thing. Likewise with Alessio De Longis, the overwhelming consensus is that we get a retest of the low maybe from this year in early next year, and then the Fed has to back off and equities rip. And I'm going to go through a couple of quotes just to share with you just how much company you've got right now. This from Marko Kolanovic at JP Morgan, who said the following: we expect the lows we've seen this year in equity markets will likely be retested in the S&P 500 early next year. We see an ongoing trend of pullback in risk assets. That's Marko. Here's Chris Harvey at Wells Fargo. We believe the S&P will trade as low as 3410 in 23 as rates eventually back up and spreads widen. Ultimately, their year-end call, 4200 on the S&P, but still a retest of the low. Does it make you nervous and more uncomfortable, Dan? And I found myself asking that question of you many times over the last few months as you get more and more company and people start to take the same view, and this becomes overwhelmingly the consensus view going into 23.
Sure. And listen, Jonathan, just because it's becoming increasingly consensus doesn't make it wrong. I think, you know, on the flip side, when we look at downside scenarios, you know, Mike has talked about this 3,000 low potential in January. Now, that would be a dramatic low from here, a downside scenario from here. I think a retest of the June lows or the October lows, call it 3,600, would be reflective of maybe more resilient earnings, maybe earnings disappointments, but not to the magnitude Mike's expecting. And I think the second thing, and you've been talking about it all morning with your guests, is about the economy. Obviously, the economy is slowing, but you could also make a case that there's some labor resilience, that there's some spending resilience, particularly on the high end when you look at the income spectrum. And then lastly, and we've talked about this year, when you look at the traditional blowups in credit, from an industry perspective, it's ironic in that given the mix from goods to services and given this massive move up over the last year in energy prices, the traditional weakest hands in credit, i.e. energy and consumer cyclicals, hotels, airlines, fundamentally, they're actually in some of the best positions from a cash flow perspective. So as long as credit holds up, as long as labor and spending holds up somewhat resiliently, you're just not going to get an enormous economic downside. So we're not saying to be all out either. There are opportunities. Just lastly, very briefly, we've started talking more and more about emerging markets as an idea.
I know you're thinking more and more about leadership beyond just EM. Dan, when it comes to tech, I want to understand where you are on that. And in the meantime, take a listen to what Savita of Bank of America had to say on tech just yesterday.
I think lessons from 2022 are that cycles take a lot longer to play through than everybody expects. And I was expecting to end the year with the world overweight energy and inflation plays and underweight tech because of the performance we've seen. But I think the lesson is that investors have muscle memory of making money in tech stocks for 10 plus years. And that needs to go away. We need a full washout, and we haven't seen that yet.
Dan, just a final word on tech if you can.
Sure, yeah, fair point. I think she's right in terms of investor sentiment and that Pavlovian urge to always go back to what worked previously. All I would say is, the reality is the fundamentals and the end markets that many of the tech stocks play into, connectivity, cloud, digitization, big data, these trends aren't going away. So in a world of free money a year or two ago, sure, the stocks were overpriced. But if we get to a point, as Ellen Zentner's expecting, of a definitive Fed pause in early 23, you might actually start to see some of the higher quality tech names start to work again.
Dan Skelly, awesome as always. Dan, you mentioned Lisa, Ellen, Mike, the whole team. It's been a fantastic year for you and the team over at Morgan Stanley. We appreciate your time here on Bloomberg. Equities right now up 1/4% on the S&P, about 11 minutes into the session on the Nasdaq, up by 0.1%. Coming up, Blackstone's response to mounting concerns over its real estate fund.
This is an industry trend, and there's two stories to this. There's the redemption story, why redemption's rising, and then there's the limit on redemption story.
That conversation still ahead.
This is Bloomberg's The Open. I'm Lisa Mateo, live in the principal room. Coming up, Mike Wilson, Morgan Stanley chief U.S. equity strategist. That conversation at 2 p.m. Eastern, 7 p.m. in London. This is Bloomberg.
There's definitely going to be a reset, a further reset. And I think anybody who knows anything about private markets knows that it's going to happen with a lag, but it is going to happen. Whether you're in private credit, whether you're in private equity, whether you're in private real estate, you should expect lower marks in the coming quarters. And again, for investors who are invested in some of the funds, that's just the expectation, but you're still getting the income on something like private credit.
Blackstone's $69 billion real estate fund rattling markets after a jump in redemptions. The CEO, Steve Schwarzman, dismissing investor concerns at Goldman's Financial Services Conference. Here's what he had to say. The idea that there is something going wrong with this product because people are redeeming is conflating completely incorrect assumptions. This was not meant to be a mutual fund with daily liquidity. These are pieces of real estate. Shanali back with us for more. Hey, Shanali.
It's a real test of the market, John, here, and this has really been the talk of the town because we haven't seen a moment like this. This is a $70 billion fund here, and when you hear what Steve Schwarzman is saying here about what happened, he is saying that they had found out that a lot of investors here in Asia had really pulled a lot of money here as the Hang Seng Index was down so dramatically. So what you're seeing here is regional investors pull pretty dramatically, but also the performance here holding up of the fund itself. He said the returns are 13% on average for the last 6 years. They're earning 9% in an environment in the first 3 quarters of the year when the S&P was down 25%. So performance itself was good, but you see a mismatch here from the types of investors that they had in this particular fund. Now, how much anxiety has been caused in the market around what we've seen around BREIT. You also saw them hit the redemption limit here for BCRED, which is a credit fund as well. You saw every single one of his rivals at the Goldman conference answer to this issue in the market and whether others are facing similar issues here. And to your point, I think we were talking in the commercial break too, how much is this a worry about underlying private assets? That is some of the worry here, but there's also a real worry here about the structures themselves. All of these asset managers, huge institutional asset managers, have been courting retail money. And a rival, the CEO of Blue Owl, has a little piece of paper on his desk that talks to the $220 trillion market in the wealth market here that they have been raising from here. So all of these folks really need these structures to work because that is a huge market opportunity. And these folks are looking for new things to invest in a real estate and credit market that has dramatically changed since 2008 and is bound to change more after this market cycle that we're seeing now.
Some big money in the mix, that's for sure. Shanali, appreciate the reporting. Thank you. We caught up with Mohammed Al-Arian last week on Blackstone's redemptions. He said it's a part of a bigger phenomenon. Take a listen.
When you run a financial system at very low rates and abundant liquidity, the financial system will optimize those conditions. And one of the ways in which it has tried to optimize those conditions is by offering liquid, relatively liquid products on illiquid asset classes. And we've seen that happen in several places, including in real estate. So when you offer relatively liquid instruments on illiquid asset classes, and the asset class becomes truly illiquid because the financial conditions change, you get what you're seeing in Blackstone.
PGIM's Taimur Hayat calling the shift into private markets inevitable, but not without risk, echoing concerns over liquidity constraints and transparency. Taimur joins us right now, I'm pleased to say. Taimur, fantastic to catch up with you, sir. Thanks for your time. Can we start there, just to get your thoughts on what's been developing with Blackstone and this fund?
Absolutely. I think this was an inevitable learning moment when a whole new client segment, retail investors, high net worth investors, came into private alternatives. It is inevitable that when you have less liquid strategies with leverage in a retail vehicle, that you can't get access to it with daily liquidity or even with monthly liquidity. So I would say these products are well structured. The big players in the market have learned from the global financial crisis how to create these. But it is a learning moment for retail investors that when you have underlying illiquidity, you can't get monthly or weekly liquidity, but the returns may be worth it. And the real question, I think, is once the redemptions end, will investors come back or will they be soured by this experience? How ready are they for the returns, but also the risks of private markets, Jonathan, is the real question.
Taimur, I'm interested in the risk in private markets and how that shapes public markets and vice versa. Clearly, if you're in public markets and you're facing margin calls and redemptions, and then all of a sudden you've got to go and get this pool of cash that you can't get because you don't have liquidity in private markets, is a private market problem a public market issue ultimately, or is it the other way around? How do you think about that feedback loop?
Yeah, I think it's very interesting, Jonathan. Really, sort of three things have happened since the global financial crisis. You had the commercial banks just step away from risky credit of all kinds, and a whole set of new actors come in. You had companies who realized they could stay private for much longer, maybe forever. And you had investors who were desperate for yield back then and said, we are going to move into private markets where we can get more yield. Now, those investors, all our clients at PGIM, discovered that actually the illiquidity premium, the diversification, a range of benefits in private markets actually makes it attractive. And I'm thinking real estate debt, private equity, private debt, infrastructure. But you're absolutely right. When, the cocooning of the world economy by the central banks goes away, some real vulnerabilities arise in private markets, and that's absolutely a cause of concern.
How are you expecting that to materialize? Because clearly these investments made sense at 25 basis points on Fed funds, maybe 1%, perhaps even 2%. How does it work at 5%?
It really exposes some vulnerabilities. Some we've already seen. We've seen the collapse of the cryptocurrency market. We've seen real estate values in the REIT market come down. So the obvious bubbles in the economy have already come. But what we are looking for next at PGIM is what are the other vulnerabilities. One is there's just less transparency and information once we move from the 5 big banks to a much broader set of private credit lenders. And I think the recession ahead, the stagflation in many countries, is really going to separate the Johnny-come-latelys who haven't really had the experience of underwriting for down markets versus those who've had that experience, who worked through multiple cycles. And I think it's also going to separate private credit, Jonathan, that relied on sponsors, where activity is really going to dry up given, they're relied on leverage, versus those who had direct origination. So there's going to be a sort of a winners and losers divide in private credit. And then the other risk I think investors should look at is more transparency in the parcel game that is happening in private equity, where with continuation funds and subscription lines, you're never getting a mark-to-market from public markets on private equity companies, but they're passing from one fund to another or getting a subscription line. I think that's a trend to look at very carefully and another place for vulnerability.
Forgive me for only giving you 30 seconds to answer this, but that's all I've got. How are you as a firm managing this risk? Time we're at PGIM going into next year.
I think this is a time for humility, it's a time for scenario analysis, and it's a time for not jumping in too soon. But nevertheless, Jonathan, we think next year, late next year, a little later than people think, this will be one of the best investment markets for both public and private assets. But patience is key.
I keep hearing that. I keep hearing the same thing. The PGIM COO, Taimur Hayat, thank you, sir, as always. Coming up on this programme, the trading diary just around the corner. Equities in the equity market trying to snap the losing streak on the S&P. We're positive by 0.5%. This is Bloomberg. Coming up to 26 minutes into the session. On the S&P right now, just about positive by 0.5%. Snapping a 5-day losing streak on the Nasdaq, we're positive by 0.4%. That's the price action. Here's your trading diary. Coming up, President Biden discussing the state of the economy at 2 p.m. Eastern time. PPI data coming up on Friday. Plus, we get the UMich Consumer Sentiment Survey. Then the big week just around the corner. CPI on Tuesday. Fed rate decision on Wednesday. The Bank of England and ECB coming up on Thursday. From New York, that does it for me. Thank you for choosing Bloomberg TV. Good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.